Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I'm going to walk you through the process of valuing infrastructure and energy alternative stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Infrastructure and Energy Alternatives is an infrastructure construction company with renewable energy and specialty civil expertise. It is headquartered in Indianapolis, Indiana, with operations throughout the country. The company's services span the entire construction process. It offers full engineering, procurement, construction, turnkey, design build, and subcontracting services. It is one of the largest providers in the renewable energy space. It has completed more than 200 utility-scale wind and solar projects. In the civil space, it offers a number of specialty services including environmental remediation, industrial maintenance, and transportation infrastructure. Let's get started with the model. This is a small cap company, 414 million market cap. They're trading at $19 a share, and they have 23 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So the company does have positive free cash flow every year. Net income is the profit and loss on the income statement. It's revenue minus expenses. And they do have positive and growing net income each year. Revenue is the sales for the company, and that grows a lot, from 780 million to 1.5 billion to 1.8 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Example of cost of revenue is cost of labor and cost of materials. The difference between those two numbers is their gross profit, and they do have growing gross profit each year, up to $200 million. Below that is their operating expenses. An example of an operating expense is depreciation. Then below that is their operating income, and they have positive operating income in 2019 and the trailing 12 months. They did have negative in 2018, and of course they had negative in 2017 because they had no revenue. Below that is the interest they pay in their debt, and then other income and expenses. This is usually impairments or other non-operational gains and losses. Then you have their pre-tax income, their taxes, and their net income. So the company does have positive net income every year, and it seems to be improving as well. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And the company does have positive free cash flow every year, except of course in 2017 when they had no revenue. The company issued $180 million of stock in 2019, and they also issued $130 million in the trailing 12 months. When a company issues stock, it increases the shares outstanding, making your shares less valuable. It does look like they're paying down more debt than they're issuing. The most important part of any business is their operating cash flow. If you cannot generate positive operating cash flow, you don't have much of a business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. The way you calculate operating cash flow, you start with net income, and then you have to adjust that number for the non-cash items on the income statement. They pass through a $48 million depreciation expense. That's a non-cash item that brings down your net income, but it doesn't affect cash flow. They also had $4 million in stock-based compensation and negative $24 million in changes in working capital. This is changes in accounts payable, accounts receivable, inventory, things like that. So even though they reported a $15 million profit, they actually generated $76 million of cash flow. Let's look at their capital structure. They have negative $72 million of equity. That means the liabilities on their balance sheet are $72 million more than their assets. They have $431 million of debt. So they're 100% debt, 0% equity. And their WACC is 13.3%. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $2.8 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $2.2 billion. We divide that by 23 million shares. And we get a calculated stock price of $98. They're trading at $19, so they're trading at an 80% discount. It's a really strong buy according to the model. Simply Wall Street is pretty close to me. They're at 102, so they're also saying the stock is really undervalued. This is the stock price the last 5 years, and you could see it was trading at a few dollars just a few months ago, but the price was really driven up past $20. It's come back down a little, but it still seems like it's trading at a major discount according to my model and according to Simply Wall Street. And this company has a beta of 1.8, so the stock is volatile. It moves a little less than 2 times the market. The stock has gone up almost 5 times the past 52 weeks, almost 500%, which obviously is much better than the S&P 500, which went up 17% in the same time frame. The 52-week low was 163, the high was 24. The stock is trading well above its 200-day moving average, but a little below its 50-day moving average. About 1 to 1.5 million shares are traded each day on this stock. Of the 23 million shares outstanding, only 8.6 million are on float. 32% are held by institutions, and 25% of the shares on float are shorted. This stock is ripe for a short squeeze because it has a high short percentage and a low float. If you invested $10,000 into this company when it IPO'd, you would have been down to about $2,000 a few months ago, but if you held on, you would be at over $20,000 today. That's a pretty good return on investment, 18% annual return. The biggest shareholder is the company at 8.5%, then Glazer, then an individual investor, then Ardsley, then Invesco. Let's look at their financial ratios. The average PE in the market's 9, the median is 14. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 30, so investors are paying $30 for $1 of earnings. Price to sales is stock price over sales per share. They're at 0.2. They have an amazing price to sales ratio. Price to book is stock price over book value per share. They're at -6 because they have negative equity. Equity is assets minus liabilities in the balance sheet, and they have negative 72 million of equity, negative 154 million of tangible equity, because they have 65 million of intangible assets on their balance sheet. Interest coverage ratio is EBIT over interest expense. They can just cover their interest payments. ROE is net income over equity. They have negative equity, so they have negative ROE. Current ratio is current assets over current liabilities. They can cover their current liabilities 1.3 times, and their current assets are 58 million of cash and 400 million of receivables. So the company does seem to be well capitalized. They did have positive free cash flow, and they have 100 million of working capital. So they have $165 million of funding. Plus, they do not pay a dividend payment. So to summarize, I have them trading at an 80% discount. And this company is in a really hot industry right now, so I wouldn't be surprised if the stock price kept getting bid up higher and higher. Plus, they seem to be really running an effective business. They have profits and positive free cash flow, and their revenue is growing at a rapid pace. I rank their free cash flow 6 out of 10 because they're positive right off the bat, and they seem to be growing a little bit, although it dipped a little in the trailing 12 months. I rank their revenue 8 out of 10 because it nearly doubled from 2018 to 2019, and it still grew again in the trailing 12 months. I rank their ratio 3 out of 10. They have a good price to sales and current ratio, but their price to earnings is a bit high, and they have negative price to book and negative ROE due to their negative equity. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.